Our second presentation is going to be economics focused, and this presentation is going to be done by Elizabeth Dooley. Elizabeth Dooley is a portfolio manager at City National Rochdale, which is a third-party money manager we use for some of our clients. And this is the first time Elizabeth is actually presented to clients. And when I told her this was going to be live streaming, she was nervous. She says, "I don't like live streaming. Why are you live streaming this?" So, it's the age of post-COVID. There's a lot of people still getting online to do everything. And so we've been actually streaming most of our events since COVID started. But Elizabeth is from Ireland. In fact, she graduated from Dublin University, and she works with our clients and our financial advisors together to help with portfolio, not only understanding and construction, but also trading individual stocks and bonds for our clients. She actually used to be a bond trader, I think, was it Citigroup? Yes, Citigroup. And so she will be presenting the second presentation this evening. Now, without further ado, Elizabeth.
Thank you. So I said to Brian, I've got some election slides at the beginning that I'll probably skip over, but I did want to build on some of the things that that Brian already covered. But I'm going to spend probably most of the time on this slide, which is what we call our speedometer page or our economic dials. As we look at where we are currently, so monetary policy, the yield curve, interest rates, and the business outlook. Those are probably the four that we're most focused on. So when we look at monetary policy, right, as the Fed has started to cut interest rates, the real question is how quickly will they be cutting interest rates, and what could the possible implications be for economic growth and also for inflation. What we saw with the recent Fed minutes coming out of the meeting, there was consensus among the Fed governors in terms of the 50 basis point cut. We were a little surprised. We had expected they would start with 25 basis points, but it almost felt in the commentary, there'd been so much talk about it that they wanted to get that first move out of the way. But what we didn't see in the minutes was really any indication that they're going to continue to move at the same pace. So we are expecting another 50 basis points before the end of the year, but we think 25 basis points or 0.25% in November, which is right after the election, another 0.25% in December. And then really the direction next year is going to depend on the economic data. They could actually go much slower next year. We do think we're going to end up somewhere in the 3.5% to 3.75% range on Fed funds. And you actually have to go back to before the financial crisis. That's when the Fed funds rate was back in that range. And if you think about before the financial crisis, Fed funds typically tracked inflation. So you were basically able to maintain your purchasing power and any money in the bank, but the Fed still had room to use monetary policy to cut interest rates if the economy was weaker and if the economy required it. So we think we'll probably end up somewhere in that range. When we look at the yield curve, so really what we're focused more on is longer term interest rates. We think we will end up somewhere in the 4 to 4.25% range. We've had a lot of volatility in the 10-year treasury and long-term interest rates. We got down into the mid threes. We're now back above 4. We think that's probably the range that we're going to stay in. With the business outlook, what we're seeing is not unusual in the run-up to an election, in that small businesses are a little bit more cautious in their spending and in their hiring, basically because there's a lot of policy uncertainty that they're dealing with. Labor costs are up, return on investment is a little bit lower, so everybody's being a little bit more cautious, which is to be expected. But when we look at the economy overall, right, and as Brian alluded to, it's consumer spending and business spending that are basically the greatest drivers of economic growth. When we look at the consumer, we would say overall, US households are in a pretty good financial position. If we look at the most recent numbers, the savings rate is up, personal income is up, retail spending is up. So overall, that's contributing to the economy. And we do think once we get past the election, that the small business side of the economy will also pick up and will also be a contributor to the economy. In terms of the equity market valuation, we would agree with Brian, right, that when you look at the S&P 500 overall, it looks expensive because of the 7 technology companies. When you take those companies out of the mix, we're closer to the long-term average PE multiple, somewhere in that 17 to 19 times forward earnings. So there is still room for the market, and there is still room for appreciation. We would also agree, in terms of the geopolitical issues. When we think about, what's going on in the world and all of the uncertainty, it always comes down to, from an investment perspective, what kind of an impact is it going to have on your willingness to spend, your willingness to make investment decisions, the willingness of the businesses that we're investing in to make investment decisions. That's really the key factor. So yes, it can create uncertainty in the short term, but really it's the investment opportunity, or it's the business opportunity over the long term. In terms of the forecast and where we are currently, so looking at the GDP numbers, so just in the last couple of weeks, we had the GDP numbers for 21, 22, and 23 were revised. The economy grew over 5%. The GDP numbers so far for this year, 3% in the first half of the year, 3% is the estimate for the third quarter. So you can see our numbers, 1.75% to 2.25%, were probably a little bit low. The economy is actually doing reasonably well. We're seeing reasonably strong growth. We expect that to continue into next year. Corporate profit growth, we're expecting 9 to 12% for the full year. We had a very strong first half of the year, and I'll go through a little further along some additional statistics on the first half of the year. The consensus estimates for next year for corporate profit growth for the S&P 500 is 16%. That's not indicative of a weak economy or a weak market. Now, we do think that consensus estimate is a little high, so we're basically somewhere between 10 and 14%. We're also seeing headline inflation continuing to come down. The biggest contributor in the last couple of months has actually been the weakness in energy, right? And as Brian mentioned, the US is, one of the biggest producers. Most of what we import actually comes from Canada. It doesn't come from the Middle East. Global demand is weak. That's mainly demand in China is weak. That's really what's keeping downward pressure on prices. Also, from the Fed's perspective, wage inflation has moderated significantly. So we're not seeing that same wage pressure that we were seeing last year. And also, while the housing component, we're still seeing inflation there, but it's actually in hotel room prices. It's not actually in home prices. So we're continuing to see signs of inflation continuing to moderate, which ties into our expectations of the Fed continuing to cut interest rates. Brian talked about the election, right, and the fact that the stock market is not partisan. This is another way of looking at the numbers, right? It's the same takeaway. The market does well regardless of administration, and it's because what's happening in the underlying economy, corporate profits, interest rates, the direction of monetary policy. Those are the key factors for the market, not necessarily who's in the White House. The other piece of it is, I think the number is something like 65 or 66% of the time since Eisenhower, we've had a split Congress. Split Congress typically means no major policy changes. That's what businesses like, right? We always say that business owners don't really care what the policies are. They just want to know what they are, then they can plan, right? Then they can decide, am I going to make that investment? Am I going to hire those people? If they don't know, they don't do anything. And that inertia is actually the worst thing for the economy and the worst thing for the market. Brian also talked about, how, and he used the green energy example, right? How it did under one administration versus the other. Similar with aerospace and defense. It actually has done much better under Biden because Russia invaded Ukraine and we have a war, as opposed to how it did under the Trump presidency. But what you could see, depending on administration, is for a short period of time, a bump in certain sectors where the market has an expectation of some policy changes. But again, it comes back to over the long term, who's in the White House and what the administration is. That's only one factor. It's everything else that's going on. That's really what determines where the opportunities are. Also, when we look at election years versus non-election years. So the dark blue line at the bottom is the election years. The light blue line is the non-election years. And you can see in the August through November timeframe, in the election years, it's fairly typical to see weakness in the market. And it's usually in that 3 to 5% range. After the election, and it's the same for both election and non-election years, November, December, you tend to see positive returns in the market. So what we're seeing is actually pretty typical. When we look, so getting back to what are some of the factors that the Fed is most focused on. The labor market is key, and the strength of the labor market. Through the summer, we had a couple of jobs reports that were trending weaker, right? And it really bolstered the Fed's case for starting to cut interest rates. The most recent jobs number popped back up. So it's showing signs of strength again. So now there's some concern as to how quickly the Fed needs to be cutting interest rates, given the fact that the labor market is in a reasonably strong position. The trouble is we can get a lot of noise in the data. So we really need to see more of a trend. But our overall view is that the labor market's in a reasonably good position. The economy is in a reasonably good position, and there is room for the Fed to normalize, right? Get us back to more normal interest rates. This I'd alluded to earlier, which basically looks at small business hiring. And as I mentioned, small business hiring has been weaker. Small business confidence has also been weaker. So the light blue line is small business hiring plans, and that's been a little bit weaker, which again is pretty typical when you have a period of uncertainty, but we expect that will pick back up once we get past the election. The other piece is business sentiment, and again, we've seen this in all election cycles. When there's uncertainty around policy, business uncertainty increases, we tend to see a pause or some weakness in investment, some weakness in hiring. So it's not unusual what we're seeing in the data this year. So somebody asked me during the break about housing, and to touch on housing. So if you look at the chart on the left-hand side, you can see since the financial crisis, we have not built enough single-family homes in the U.S. That's the big problem, right? The economy's been growing. The labor market has been reasonably strong. New households continue to be created. So demand for housing remains strong. The baby boomers, everybody's living longer. They're not moving, right? So you don't have the pre-existing homes coming onto the market. Part of the reason people are not moving is because it's too expensive to move. Why would I move to pay the same for something smaller? Right? That's the response we hear all the time. But that makes the problem worse, right? Because there's not that supply coming back into the market. The other thing that happened coming out of the financial crisis, remember all of the foreclosures, right? And all of those homes that couldn't be sold? that were bought up by the hedge funds and the private equity funds. Well, guess what? They realized it's a really good investment and it's a really solid cash flow. So you have a pretty significant supply that's also not coming back onto the market. And this is probably, when we think about what can be a negative for the economy, because construction, all the things that we spend on to put into our homes, right, all of that helps to support some of the economic activity. That's weaker than it would normally be because we're not seeing that pick up in activity. The other part of it is for new building. We are seeing new building, but we're not seeing the 100 spec homes. We're seeing 10 and they're sold, and then they build another 10 and they build another 10. Construction costs are higher, labor costs are higher. This will resolve itself over time, but it's a very slow process and it will take a long time to resolve. So when we think about what can be a contributor to inflation, it's the housing component, right? Because if you can't buy, chances are you're probably not still living with mom and dad, but you're renting, right? So you've got significant increases in rent, and that gets tied into inflation. So that's something that the Fed pays attention to. Lately, with the 10-year coming down, right? Mortgage rates had come down, they've popped back up again. But if mortgage rates come down a little more, there's less of a reason for somebody who has a low interest rate mortgage not to move, right? So we may see a little bit more activity, but again, it's on the margins, right? So when we think about what can be a negative or something that we're cautious on for the economy, it's definitely what we're seeing with housing. In terms of the Fed and interest rates. So the chart on the left-hand side looks at what the Fed fund futures, so what the fixed income markets are predicting. And if you look at the Fed fund futures, so on the top line, the green line, it's basically saying in terms of how quickly interest rates will come down. So the bottom line is showing interest rates coming down quickly, which is what you would expect in recession. That's what the market is pricing in. The top line is what we actually expect. Now, if you look at the last 18 months, the Fed fund futures has been dead wrong on the direction of interest rates and how quickly the Fed would cut interest rates. So we're not overly concerned about what the Fed fund futures is saying, but it just kind of shows you the volatility that we can see in the market. We do think the direction, as I said, is that interest rates will come down, but interest rates will come down slowly. And the 10-year Treasury, that will be somewhere in the low 4% range. The other question we get a lot relates to the consumer. A lot of headlines around credit card usage, default rates going up, concern about the financial health of the consumer. So the chart on the left-hand side looks at delinquency rates, and you can see, yes, they've crept up, but they're still way below where we've been historically. So households are in a good position. The interest rates on credit cards are up significantly, right? So that is definitely having an impact. Also, when we look at who is most at risk, so we talk about high income households versus low income households. So the first quintile, right, the lower income households, they tend to have lower credit card limits. They're using more of the limits. You look at the higher income households, they still have a lot of room to grow, a lot of room to spend. The chart on the right-hand side looks at the percent of balances moving into delinquency. It's the lower income households where we tend to see that stress. So when you hear things, talking about credit card balances, talking about used car loans, some of the, we'll say the lower end retailers, Dollar General, Big Lots, they're struggling, right? That's all reflected in what's happening with the lower income households. Think about the last couple of years. The lower income households benefited more from the payments during COVID. It was a greater percentage of their household income. That's come to an end. Most of that money has been spent, and they're back living paycheck to paycheck, right? So that's where we're seeing more of the stress. But if we look at higher income households, the labor market is strong. There has been tremendous wealth growth in the U.S. in the last decade. So if you're invested in the market, right, Brian talked about the returns, right, up over 70%. Significant growth in investment portfolios, and home values are up. So if you own your home, you have investments, you've seen significant wealth growth. That's the consumer base that has disposable income, that drives consumer spending, and ultimately drives economic growth. And that's really what we're focused on. Switching over to the market and to earnings. A lot of data on this page. But if we look chart on the top left-hand side, which looks at earnings growth by sector, and you can see, for the most part, most sectors within the S&P 500 have had stronger earnings growth. If we look at the second quarter numbers, so the chart on the top right-hand side looks at the earnings surprises. So we had a greater number of companies that surprised to the upside. The chart on the bottom left-hand side looks at the size of the surprise. So it was a little bit lower than what we've seen historically. But nevertheless, we had more earnings surprises. And then the chart on the bottom right-hand side looks at the number of companies that reduced their guidance going forward. So we actually had less companies reducing their guidance, which is a really positive sign for corporate earnings and for the market, because usually companies are very, very cautious about increasing their expectations. They don't want to miss, because they know if they miss, they will get punished. So they're much more focused on managing the expectations as opposed to increasing the expectations. So again, we see this as a positive sign for the market overall. We've also seen significant bond issuance. U.S. corporations are in a good financial position. We've seen significant issuance. We've seen significant demand for the bond issuance, because we're finally back to, you can get a reasonable return from bonds, right? So working with Brian and Carmen and all the folks at EBW the last 15 years, right? For a very long time, you could get little to no return on your bond portfolio. So we had very small or very low bond allocations, and we were looking elsewhere for income. We don't have to do that anymore, right? So you can get a reasonable return on your bonds. You don't have to take as much risk in your overall portfolio. You can get the returns that you need for whatever your financial goals are. Brian talked about all the advancements and all the changes that we've seen over the last 20 years. As we look forward, right, AI is probably where we see the biggest opportunity. We're just at the very, very beginning. So we see significant opportunities here as we look out over the next 10, 20 years. And if we look at it in terms of where the opportunity set is, it's very broad across different parts of the economy, different sectors of the market. And we're really only at that early stage of automating, having more productivity, right? We talked about the labor force, the challenges of a tighter labor market. If you're not able to grow your labor force, you have to grow your productivity some other way. And this is really where the technology and the automation and that continued investment comes in. And as we look at the projections forward, this could be upwards of 10% of US GDP. So again, we see significant opportunities here. We're pretty comfortable with the companies that we're currently invested in. And then as we look forward, and Brian spent a lot of time going through this in terms of what matters most for the economy. It's the direction of interest rates. And what really matters is it's the pace at which the Fed is cutting interest rates. So we talk about a fast easing cycle and a slow easing cycle. Less than 6 months, we classify as a fast easing cycle. Usually, if the Fed is cutting interest rates that quickly, they're responding to an issue in the economy, or they're responding to concerns about recession. We think the more likely outcome is a slower easing cycle. In a slower easing cycle, the economy is still doing well, corporate profits are still growing, so that tends to be a positive for stocks, and that's really what we're looking at here. So the let me see, the light blue line is basically the average of the slow easing cycles, right, which is the top line on the chart. Also, what we've seen really in the last couple of months and probably since the end of June, we've seen more sector rotation, right? So as interest rates are coming down, there's less of a drag on other parts of the economy. Also, it's a function of more money coming into certain sectors. So for example, last year, utilities, consumer staples, real estate did poorly, partly because investors were pulling out of those stocks and going into T-bills and CDs and money markets and collecting 5.5%. Since June, that has started to reverse, right? Because investors realize the 5.5% is going away. These companies' valuations actually look very attractive. I can not only lock in a reasonable yield, but I have the potential for that dividend to grow over time. So you're seeing it in terms of how utilities, REITs, and financials have performed relative to the S&P 500, right? So we've seen stronger performance out of those sectors since the end of June. The growth stocks, technology, industrials, financials, they're still growing. We're still seeing positive returns, but the rate of increase has slowed a little bit, which is what we would expect to see. And then what we're also seeing is, in addition to sectors within the S&P 500, so the Russell 2000 is the mid and small cap universe. Smaller companies tend to do better in a lower interest rate environment because smaller companies tend to borrow from the bank as opposed to issuing stocks, right? So they're more susceptible to interest rate fluctuations. So a lower interest rate environment should be a better environment for those companies. And then tying it back into fast cycles versus slow cycles. So in a fast easing cycle, where the implication is economic weakness, the growth sectors underperform because everybody's concerned that they won't see the growth that they're paying for. The defensive sectors, the necessities, tend to do better. Whereas in a slow easing cycle, as I said earlier, the economy is still growing. All stocks tend to do much better in that kind of an environment, which is what we're expecting as we go through next year. And then to summarize, right? So we see the economy continuing to grow. The economy is resilient. The Federal Reserve continuing to cut interest rates. The market will be volatile. Brian mentioned it in terms of social media. There's a chart that we always use when we do the client reviews, which basically looks at volatility in the S&P 500 going back over 40 years. There's a huge difference between volatility in the market pre-2000 and post-2000, right? A much bigger, much more frequent swings, much bigger swings, and a lot of it is reacting to short-term information, right? And we see that continuing. Corporate profits, we expect to continue to grow, inflation to continue to moderate, job market is strong. So overall, we're positive in the outlook for the economy. And then at the very end, we've got some key takeaways in terms of different asset classes and where we want to be positioned. The main takeaway is we favor U.S. equities. We're cautious on international. We see opportunities within fixed income. So Brian, I'm going to end it there, and maybe we can start with some questions.
On your previous slide, you had the market is underestimating the effects of AI.
Mm-hmm.
Is that in terms, or one, can you expand on that? And is it in terms of job loss and job creation that will affect the economy?
No, it's actually saying that we have a positive outlook on AI going forward. What you saw coming out of the second quarter earnings numbers, it was almost like everybody hit pause, and you had a significant increase in concern about the earnings of those companies, the earnings potential of the Magnificent Seven, and their ability to grow their earnings at the same pace going forward. So you had investors starting to question a lot of the capital investment and how long it would take for that capital investment to actually show benefits for investors. So we're basically saying we think there's still a lot of room in that trade, and a lot of opportunity for growth.
In your analysis of lower, middle, and upper income uh, household situations, could you tell us what those levels are? What level you use for lower, middle, and upper incomes?
Uh, I don't actually have it in terms of what the wage percentages are, um, but I'm going to guess and say we're probably under 70,000 or so for lower income. We're probably 70 to 400 or so for middle income, and then 400 and above is going to be the higher income.
Hi. So looking at the global economy, it seems like China has a number of economic crises which are coming home to roost. Europe is slow to recover from COVID. South America is having its own difficulties. What do you think the future is for the economy, global economy beyond the United States, and what risks, if any, does that pose for economic growth in the United States going forward?
So probably the question we get the most is, how come we're so US focused? And how come we don't have investments outside of the US? And it's basically for all of the reasons that you just referenced. Um, if we look at Europe, the Eurozone really hasn't recovered from the financial crisis, never mind COVID. And a lot of that has to do with the decisions that were made during the financial crisis. Now, it seems like a lifetime ago, but the European Central Bank raised interest rates in 2008 because the whole idea was austerity will solve the problem, right? If we cut spending, it will solve the problem. They realized in 2011 that that was actually a really bad idea, that it wasn't working, and they went in the opposite direction. But the problem was it was too late. They had already killed consumer confidence. The other piece of it, and a lot of it has to do with interest rates and how short-term interest rates affect households. The US is one of a very, very small handful of countries where you can get a long-term fixed rate mortgage. The rest, right? So when you think about who's holding the risk, it's not you, the homeowner, it's the financial institution. That's who's holding the risk, right? Because they can sell the loans to Fannie Mae, so really it's the US government that's holding the risk. It's the exact opposite in the rest of the world. So whenever short-term interest rates rise, it directly impacts the consumer, and it directly impacts consumer confidence. So when you think about what drives economic growth, if the biggest part of your economy is struggling, business spending and government spending are never going to make up the difference, right? Which is a big piece of it. And it's not to say we have no US or European companies in our portfolio. We have one or two, but for the most part, we're very cautious on Europe. And we keep getting the question, well, European stocks are cheap. Well, yes, they are, but they're cheap for a reason, right? And when you think about where's the innovation, and I think COVID's a really good example, right? So for all the scientists who were looking to develop the drugs for COVID, where did they come? They came to the US. They might have been educated outside the US, but they came to the US for the capital investment. And that's what we keep coming back to, right? It's the capital investment. When you think about China, so basically China had 30 plus years of significant growth. But China was never going to be in a position that was different to everybody else, right? China is going through the same thing that every developing economy goes through. You have a significant advantage at the beginning because you've got cheap labor. But as time goes on and you get into that second and third generation of labor, well, they don't want to work in the factories. They want to be lawyers and doctors, right? So they're experiencing the same increase in labor costs that every developing economy does. And then you've got a housing bubble and you've got everything else that was going on in China, right? So as investors, we're very cautious on China, but also the philosophy of the Chinese government completely changed, right? It was growth at any cost, and now it's internal prosperity, right? So it's very focused on, quite frankly, keeping everybody happy at home and not having a lot of political conflict, right? Is really the biggest concern. And then we look outside of China, look at other emerging markets. You've seen periods in the last couple of years where there's been a lot of focus on India. India is a democracy. India is not like China. So there's pockets of growth, but there's not really enough to sustain a sort of a long-term investment theme for at least as it currently stands for India. So it's a real challenge trying to find those opportunities outside of the U.S. Emerging markets tend to do better when the dollar is weaker. We see the U.S. economy remaining strong, which means the dollar remains strong, which is going to be a challenge for those investments.
Again, segue to the same economics by numbers. You mentioned China and India. So it looks good, very nice on papers that, I would personally like to have every manufacturing job brought to US.
Mm-hmm.
But China is going through its own pains and etc. How do you see, how does it pan? How does a soothsayer see in 5 and 10 years that without compromising on the quality,
Mm-hmm.
you see, China has first, secondary, and tertiary sectors where I won't call it dump, but they route their goods, you see. And we don't want to be secondary and tertiary because we have the dollar power. If we have to have a balance of getting the jobs, manufacturing, Boeing, the more automobile and real manufacturing jobs here, how do we do it? How does it pan out, from the economics standpoint? Factoring in China,
Mm-hmm.
China's manufacturing, factoring in India. I mean, India's coming up in a very big way.
Right.
And probably other sectors, Mexico, I don't know.
It's not all or none. Right. So it's almost like we're looking for it to be completely one way or the other. And I think what you're seeing is, and particularly coming through COVID and supply chain disruptions, right, is that all businesses globally, not just US companies, understand that the stability of their supply chain is key. So if you make a choice to manufacture outside of the US, then you have to hold more inventory for when those times, that there will be some disruption. Think about the potential for a port strike a couple of weeks ago, and everybody was stocking up on toilet paper and everything else, right? So it is. I think it's not, as I said, it's not one way or the other. There probably will be some manufacturing that will come back to the U.S. where it makes sense, where the economics make sense. The other piece is, and I haven't seen the chart in a while, but if you look at manufacturing capacity in the US versus manufacturing employment, manufacturing capacity has gone straight up and to the right. Manufacturing employment has gone straight down because a lot of the manufacturing is automated. Think about auto, car production, right? More and more of the manufacturing is automated. So if we have AI, more automation, you could have more manufacturing located in the US. The profitability makes sense, the cost to the consumer makes sense. I mean, the big worry is the US has benefited from importing lower prices for decades. right? If more of that manufacturing happens at home, labor costs are higher. How do you offset labor, right? If it's not labor, it has to be automation. So I think there'll be certain areas where it makes sense. There'll be probably certain sectors where, from let's say, a national security perspective, there's probably going to be more of a push to have it at home. Probably our biggest concern today, when we look at all the geopolitical issues, is China and Taiwan. Taiwan Semiconductor is the biggest chip maker, right? Every single thing you own and use has a chip in it, right? Again, we saw this with COVID. They couldn't get the chips, so they couldn't manufacture the cars, right? I think it's almost like COVID was a trial run, right? In a sense, right? Because it showed us what can happen and how reliant we are on certain things that we've taken for granted for decades. So I think it has been a wake-up call for, I think, us as consumers and for businesses, right? In terms of thinking, how do you protect your business, protect your market share going forward?
I agree. I mean, in sectors like semiconductors, you just mentioned Taiwan. I mean, NVIDIA and all the top technology, Apples and all that. It's very easy to integrate and implement AI, you know. But manufacturing is altogether a different ballgame.
Exactly.
And that is the reason I asked that, it's to transcend those, to, get those things and inculcate it in the US. That is a very complex thing, and which obviously an expert would have an insight into.
Right.
I'm not a soothsayer, and
Look, I think that's why coming out of the second quarter earnings, it was almost like, anything AI related was on a tear. And then somebody woke up and said, well, hang on a minute. They're investing, there's all this huge capital investment. When are we going to start to see the results? All the companies making the investments understood that these are decades-long investments. It's not every quarter is Apple going to come out with a new, variation of the iPhone. It's long-term investments, and I think part of it is getting investors to understand it's long-term investing, right? There's going to be short-term benefit, and there'll be changes over time, but these are very long-term investments.
Thank you.
Hi, Elizabeth. I was wondering if you could address the national debt, but from a different perspective than the way Brian did it. And what I mean by that is, we're paying about $1 trillion of interest a year, and by the end of 2025, it'll probably close to 1.5 trillion. And so my question is, that now makes it larger than the defense, larger than non-defense, larger than Social Security, and approaching Medicare. Can you talk about how that is going to affect changes potentially economically in the way that we do business and or make investment going forward?
Well, I do agree with Brian in terms of we control interest rates, right? So we're not concerned about the cost of the cost of managing the debt is going to balloon. But we agree that it's unsustainable for it to continue at the same pace. But I think it was a key point, right, that you can see the significant increase was in 2008 and during COVID, when the decision was made to support the economy. Because the decision was made to support the economy, we are where we are. Europe made a very different decision, and the Eurozone is where it is, right? So we've definitely seen the growth. I think probably the biggest piece of it, though, is when you look at the debt overall, it is Social Security and Medicare. Those are the biggest pieces of it. It is very unlikely that we're going to elect the politicians who will say they're going to cut it. So it's more likely, right, it's going to be at the margins. If you're in a higher income bracket, your IRMA is going to cost more of it's going to be taxable, right? That's what they'll do to address it. But I think the bigger issue looking forward, and really all the developed economies are seeing the same thing, is that if more of your government revenue, it's like a household, right? If more of your revenue is going to support your debt burden, you have less left over to invest. So you're not necessarily seeing the government investment in the economy to support the long-term growth. So you're more reliant on the consumer and then business investment to actually spur the growth in the economy. And Brian and I talked about this a couple of weeks ago, but there's a chart that we used to have in the deck 10 plus years ago, which talked about the exact same problem. And basically, the prediction was that in 10 years, all developed markets would be growing at a slower pace. Well, that's where we are, right? So overall growth is much slower. The concern is as the debt burden continues to grow, that becomes much more of a concern going forward. But it's decades away, right? It's not the next couple of years. It's decades away. Thank you.